Welcome to another episode of the Canis Major Incubator Commercial Multifamily Real Estate Investing video blog. The Canis Major Incubator is the premier platform for Texas commercial multifamily investing. Each week we make a short educational video about investing in Texas commercial multifamily real estate. So stay tuned at the end of this video to find out more about training, investing, funding for, and getting support for actively or passively investing in Texas commercial multifamily real estate.
Hello and welcome everybody. Welcome to the Canis Major Weekly Deal Blog. I'm Phil Grove, and each week we look at a commercial multifamily real estate strategy, technique, or benefit or resource here in the state of Texas. And this week we're going to be talking about tax efficient commercial multifamily investing. And we have one of our acquisition specialists here in Texas is going to be leading the conversation today. His name is Surajit Kaur. And Surajit, are you there?
I am, Phil.
Well, I'm going to turn it over to you, buddy.
Thank you, Phil. All right, so the topic of today is tax-efficient commercial multifamily investing. And what I'm going to take you through is frame how commercial multifamily investing works in general. I'll talk you through some of the cash flows, and I'll really focus your attention on some of the tax-efficient strategies that are commonly applied. First, a little bit about myself. So I'm based in Dallas. I have a couple of interesting degrees, an MBA from Cornell. I have a PhD in aerospace engineering, and I've heard many rocket scientist jokes over the years. So if you've got a new one, I'm always ears. In terms of a career, I spent several years working at PricewaterhouseCoopers, PwC, as many of you know it, and another firm called PRTM. And have been spending my time over the last several years doing a variety of real estate investment things, ranging from single-family buy and holds to a lot of syndicated investments in commercial and multifamily transactions. I think over the last maybe a year or two, I've probably made 8 or 10 syndicated transactions, and have come to learn quite a lot about how these work and how to make them work for you. I've had the pleasure of working with Phil and Shanoa since the start of the year. And now I play an acquisition specialist role focused on the Dallas market, the North Texas market. So that's a little bit about myself. First, a couple of disclaimers. So we're going to be discussing today several common tax strategies that are fairly widely used by commercial multifamily deal sponsors as well as their investors. But neither I nor Canis Major are qualified tax CPA professionals. And so the material that we're going to cover here is really not tax advice. So we strongly encourage all of you as investors to consult your CPA, your tax advisor, before making an investment. This does not qualify as tax advice. So with that as some caveats and disclaimers, let me move into commercial multifamily investing in general. So you see a couple of nice pictures, an apartment complex on the left, a strip mall on the right, just classic examples of multifamily and commercial investments out there in the real estate world. There are many advantages to making investments in commercial and multifamily transactions. You get a piece of the ownership of the investment, so you get equity ownership. You get passive income, and the operative word there is passive. You don't really have to do a lot other than select the sponsor and make your investment. So the passive income is very attractive to a lot of investors. You often get fairly strong returns on your dollar, ROIs north of 20%, something like that, which is pretty attractive for long-term investors. The cash flows are predictable. They are actually very predictable down to the annual level and down to the quarter level. So that's very attractive for certain types of investors. You can invest with your IRA money, tax-deferred money, or tax-free money, but you can also invest with non-IRA dollars, straight cash out of your investment fund or your personal dollars. The focus of this conversation is really on the tax advantages. I'm not going to say any more about the other advantages, but really focus on the tax advantages of commercial multifamily investing. So I wanted to frame the conversation with the general flow, the general anatomy of a typical commercial multifamily deal. I won't belabor the bullets, but I will talk about the broad structure. So typically, there are 5 phases in a commercial multifamily deal. There is the identification of an asset. Asset could be a multifamily property that exists, or could be a plot of land that could have the potential of a multifamily property. So the identification of an asset. There is typically some effort that goes into structuring the deal with bankers, senior debt financing, with equity investors, due diligence, all of these things that go into actually structuring the deal. There are several things that go into acquiring the asset: closing of the deal, funding the transaction, legal control, financial control, those sorts of things. The bulk of the work, the bulk of the effort goes into improvement of value of the underlying investment. If this is a multifamily investment that was underperforming, then a lot of the effort goes into turning the multifamily investment around, improving rents, capital improvements, additional sources of revenue, those sorts of things. If it is a plot of land on which a strip mall is going to be built, you get into things like entitlement and design and plan and architecture and construction. Many of these deals last for typically 5 years. Some are shorter, some are longer, but 5 years is a fairly common runway, at the end of which the asset is transacted, i.e. it is sold. So the effort that goes in here is around finding a buyer, closing with the buyer, all of the financial management of paying off debt, paying equity investors, and liquidating the holding entity. So those are the 5 pieces of a traditional commercial multifamily deal. And you as an investor come into the equation kind of typically around the deal structuring and all the way through the transaction, which leads me into what this would look like for you as an investor. So on this page, we show what would typically happen for you as an equity investor. So let me take you through this from left to right. You may choose to make, let's say, a $100,000 investment. You make a $100,000 investment at the start of the transaction with the sponsor. Many of these commercial multifamily deals have the value proposition around doubling your money in 5 years. So the way that works is you make your investment in year 0, typically right before the deal is closed. From that point forward, for the next 4 years, year 1, year 2, year 3, year 4, I'm showing, just for illustrative purposes, a 10% return. So you invest $100,000, you make $10,000 in year 1, $10,000 in year 2, $10,000 in year 3, $10,000 in year 4. And by the way, all of that was passive. Once you've made the transaction, you're really not doing anything, right? It's all straight return to you. When you get to year 5, several things happen.
And Surajit, not to interrupt you, but I think it's also worth mentioning when you get that money back, you're not actually getting interest or taxable money back. You're just getting your capital back. You're just getting your original investment back. So you don't pay any taxes for those years, correct?
Exactly, Phil. And I was just going to touch on that. So that is, in fact, one of the most potent tax strategies that's typically deployed, right? You get your $10,000 back, Phil, you're correct, in year 1, 2, 3, and 4, but it is treated as a return of capital. It's like you're getting $10,000 back of your initial $100,000, and so therefore it is effectively tax-free. You're exactly right, Phil. So continuing on that, by the time you get to year 5, and this kind of rounds out the point you were making, Phil, is by the time you get through year 4, you've been paid back roughly $10,000 times 4, $40,000 in your original capital, which leaves about $60,000 of original capital back. So in year 5, that capital comes back to you, the residual $60,000. But what also happens is that obviously a transaction only makes sense when the valuation of the property is much higher in year 5 when it is sold than when it was bought. And so the gains are returned back to equity investors after paying off senior debt. And that's what is described here as that pink bar on the upper right-hand side. So I'll build on that, Phil, by going to the next page and talk about kind of the gamut of investment and tax strategies that are used here, and we've touched on one of them already. So on this page, we show the same cash flows, but here's the spectrum of tax strategies that are typically applied. The first is on the left-hand side. You can make these investments with your non-IRA money, but you can also make these investments with traditional IRA funds or Roth funds. If you were to do that, then all of the cash flows that you see, everything to the right of year 0, follows the same tax structure as your original investment. If you invested as a traditional IRA, your money was tax deferred, and all the subsequent gains are tax deferred. If you invested with a Roth, all the subsequent monies are tax-free. If you invested with neither IRA money nor Roth money, essentially your regular cash balance, you still get significant tax advantages. And Phil, I think you touched on the first one. So in years 1, 2, 3, and 4, your distributions, the $10,000 distributions, are treated, and there's a very subtle word here and a very subtle spelling. The distributions are treated as return as capital. It is your original capital being returned to you, not return on capital, which would be taxable. And because those distributions are treated as return as capital, they come back to you, the investor, tax-free. In year 5, two things happen that are attractive from a tax perspective. The $40,000, the $60,000 return, that is your residual capital, comes back to you again, tax-free, so no taxes due at all. But the beautiful part is that the $100,000 return, which is the pink bar, is now taxed as long-term capital gains, not ordinary income and not short-term capital gains. For, I think most investors know that long-term capital gains rates are lower than short-term capital gains, lower than ordinary income. And so their strategy is very helpful in reducing the tax burden on the $100,000 gain at the back end. So those are the primary strategies in terms of the transaction itself from year 0 through year 5. Beyond year 5, there are a few additional strategies that are commonly applied, and I'll just touch on 3 of them. The first one is one where the sponsor can work with the equity investors to, in fact, collectively decide to not transact the property in year 5. It may be more tax advantageous to, in fact, refinance the property, pay back the senior loan, maybe make some partial payments back to investors, but let the property cash flow beyond year 5. At the point at which your initial capital, your initial $100,000 is paid back, that investment essentially generates infinite returns to you. You have no more capital left, but it is continuing to cash flow, let's say $10,000 a year, essentially for infinity. So that's a very attractive tax strategy, but it requires the equity investors to work with the sponsors and agree on a path forward. 2 other mechanisms. So the investor pool, let's say there's 30 investors in this transaction. All 30 investors may decide to do a 1031 exchange into a subsequent property, a subsequent deal, and do a 1031 exchange to tax shelter and tax defer the capital and the gains for another 5 years. And the last strategy is maybe not all 30 investors, but maybe just you as an investor may decide to tax shelter your investment proceeds and gains in a 1031 exchange just for yourself. So I touched on these 3 strategies. I won't go into any more depth. They are actually the subject of more advanced tax planning. But I would like to close out this session by reminding you that, again, we're not tax professionals, we're not accountants, but these are fairly common tax strategies, and we always advise you to consult your tax professional or your accountant before you make these investments. With that, I'll wrap up this presentation, and Phil, I'll turn it back to you.
Well, Surajit, I just want to thank you again for presenting this and sharing. You've been really crystal clear in your explanation of this. I'm going to summarize this for my own understanding, just to make sure I understand. Typically, this is a typical structure of a commercial multifamily project. In the first example you gave us, essentially you get all your money back in 5 years, and then you get 100% return on your money. So you doubled your money in 5 years. And because the money was paid to you as a long-term capital gains, you don't have to pay employment or income taxes on that money. You only have to pay long-term capital gains tax. So that's option 1. Option 2, you could, instead of getting all of that profit back, you could just get all of your money back and leave the profit essentially in the deal, but continue to get return, that cash flow every month for the rest of your life. So that's what you mean by infinite rate of returns, is you get all your money back and you now get all the cash flow from that property forever, because the property's been refinanced to pay you back your capital, which is pretty cool. Or the 1031 exchange, where the IRS says if you take your profits from a real estate transaction and you just invest them in another real estate transaction, the taxes are indefinitely deferred. So if I bought a house or a building for $100,000 and I got $200,000 back, well, normally I'd have to pay my taxes on that $200,000, or at least on $100,000, the gain of the $200,000. But if I invest that $200,000 onto another project, now I've got twice as much money to invest. As long as I continue to reinvest it, I don't have to pay any taxes. I defer the taxes until the very, very, very end, until someday far off in the future where I might decide to take that capital and do something else with it. So pretty interesting set of options that commercial real estate investors have. This is certainly one of the big reasons why you should invest in commercial multifamily projects. So, Surajit, did I summarize that reasonably well for my own understanding?
You did, and the only last point I'd like to make, Phil, is that you can defer taxes, but eventually it catches up to you at some far point in the future. So you're absolutely right. The longer you can defer paying the taxes, the better off you are. At some point, who knows when, 3, 4, 5 transactions later, you will end up having to pay taxes, but hopefully your situation at that time will be different, and you can tax optimize at that point.
Yeah, I like to say I keep building my net worth, and I keep building the passive income, and I'm just going to keep growing it and growing and growing it. I'm going to leave the whole mess for my kids to figure out when I'm gone. So you can also defer it to their problem. So thank you again, Sergio, for your very informative presentation today, and thank you all for joining us for the weekly Canis Major Deal Blog. We do one of these every week, and we look forward to having you guys spend some time with us on the next deal. So thank you all, and have a good day.
Hey there, Phil Grove here again. I hope you enjoyed that video case study. If you're interested in investing passively or actively and want to get more involved with our network, just fill out the form on this page. There should be a button or link somewhere on this page. Just fill in your contact information and our team will reach out to tell you about our next training opportunity where we can meet in person. And you can see what our network is all about and how you can get involved yourself. Just to tell you a little bit more about the Canis Major Incubator, the Canis Major Incubator is the premier platform for Texas commercial multifamily investing. Investing in commercial family historically has been something that is kind of shrouded in mystery. It involves investing in multi-million-dollar projects, and when people want to put together multi-million-dollar deals, they have to pool money from multiple investors. And when you pool money from multiple investors, well, guess what? The Securities and Exchange Commission regulates such activities. So you can't just solicit people at random to invest in commercial real estate. Instead, you have to make sure that they are first sophisticated investors before they can even participate in these types of transactions. So it's some of the best known secrets and opportunities in the investing world, real estate or otherwise, is in commercial multifamily. But the reason you don't know about it is because you are probably not yet a sophisticated investor. In fact, you have probably not yet been trained and certified as sophisticated. So the Canis Major Incubator provides training for people that are interested in commercial multifamily investing to make them into sophisticated investors. The Canis Major Incubator also provides deals to investment. We have a network of over 1,000 investors, deal sponsors, and what we call acquisition specialists across the state of Texas that are sourcing and negotiating and putting together commercial multifamily investment opportunities for members of the incubator. The incubator also provides funding for commercial multifamily real estate. The incubator is a private funding platform of over 1,000 Texas high net worth sophisticated investors for funding Texas commercial multifamily deals from Texas-based deal sponsors. And then finally, the incubator provides support, a network of Texas-based coaches, deal sponsors, and deal co-sponsors for training and supporting people wishing to become active and or passive investors of commercial multifamily deals here in Texas. So to get more involved in the Canis Major Incubator, to become a sophisticated investor, just fill out the form and click on the link somewhere on this page, and we'll reach out to contact you to get you more involved. Thank you.